Federal Reserve Bank officially cutting interest rates. The question on everybody's mind is, what is this going to do to the stock market in 2024 and 2025? But instead of making a random guess, I want to take a look at history. Because while history doesn't exactly repeat itself, it does rhyme. And I'm going to take a look at the last 6 Fed rate cutting cycles and go over what that did to the stock market. And then I'm going to go over how interest rate cuts actually affect inflation, because I think there's a lot of wrong information floating out there about how interest rates and inflation go hand in hand. So let me start by going over the last 6 Federal Reserve Bank rate cuts and what that did to the stock market, and more specifically the S&P 500. In 2020, when the pandemic hit, the Federal Reserve Bank cut interest rates by 1.5%, and the stock market in 2020 rose by 16%. In 2019, the Federal Reserve Bank was also cutting interest rates. They cut interest rates by 0.75% because they were worried about a potential recession. And in 2019, the stock market rose by over 28%. In 2008, the Federal Reserve Bank cut interest rates by 4.25% to fight off the recession. And in 2008, the stock market fell by over 38%. In 2007, the Federal Reserve Bank cut interest rates by 1% in a proactive measure to prevent a potential recession, because we were starting to see the economic worries happen. And in 2007, the stock market rose by 3.5%. If you remember, that was when the stock market was breaking new highs before the big recession happened in 2008. In 2003, the Federal Reserve Bank cut interest rates by 0.75%, and the stock market rose by 26%. And in 2001, the Federal Reserve Bank cut interest rates by 4.75%. This is after the dot-com bubble burst. And the stock market fell by just over 9%. And this is where now you got to understand that sometimes the Federal Reserve Bank cuts interest rates and markets go up, and sometimes they go down. You can't just look at interest rates by themselves as a determining factor as to what is going to impact the stock market. You have to understand how interest rates impact the economy. But before we talk about that, I want to talk about interest rates and inflation and how it actually impacts inflation. So let's go over that, and we have been covering this in Market Briefs. Market Briefs, by the way, is my free financial newsletter, where every day my team is breaking down what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy-to-read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below. So now, if we take a look at what impacts inflation, let's first define what inflation is. Inflation comes from the word inflate. What are you inflating? You're inflating the monetary supply. You're inflating how many dollars out there. So to really understand how interest rates affect inflation, we need to take a look at the government. Many times people like to talk about the housing market and cars and businesses, but let's take a look at the government, because that will really help you understand how interest rates impact inflation. And to understand this, let's take a look at an example. If you wanted to go out and buy a home, you can borrow more dollars at a 4% mortgage than you can at 8% mortgage, because, well, it's cheaper. It's the same thing for the government. When the government goes out and borrows money, it is cheaper for the government to borrow more money when interest rates are lower. And what we've been seeing is the government is already, or has already, been spending a lot more money than what they generate from taxes. Let me give you an example. In 2024, the United States federal deficit is expected to be $1.9 trillion. That means the government is expected to spend almost $2 trillion more than what they generate from tax dollars. But the $1.9 trillion that they budgeted as their federal deficit, this was based off of the previous interest rates, which were higher. So when the government is budgeting how much money they can actually borrow, they have to base this based off of what interest rates are, because when interest rates are higher, their payments on this debt is higher. And when interest rates go down, then they can, in theory, borrow more money because their cost on that debt is higher. And the reason why this is so significant is because interest payments for the United States government have been skyrocketing, especially with the higher interest rates. In fact, interest payments for the United States government are now the 3rd largest expense for the government. We pay more money in interest every year than we do on our own military. Why is this significant? Because Well, if the government has the ability to borrow more money for cheaper, then they can borrow more money, because we know that the government is in a system where now we like to spend money that we don't have. We've been running a national deficit for decades now, and we have about $35 trillion worth of national debt. Here's why that's significant. Because when the United States government goes to borrow money, they can borrow money essentially from three entities. Number one, they can borrow money from private citizens and businesses. So the United States government can issue what's called a treasury, which is where you can go out and loan money to the government. The problem is there's not enough money floating around in the country in the hands of people and businesses to lend enough money to the government to fund all their needs. So the government has to do more than that. And so that's when the government can then go to option number two, which is borrowing money from foreign countries like Japan and China, which they already do and have been doing. But again, there's not enough money that the government can borrow from these countries without creating more economic threats or concerns. And so when the government taps out on that, that's when the government goes to option number three, which is where they then borrow money from the central bank in the United States, which is the Federal Reserve Bank. Now, the interesting thing about the Federal Reserve Bank is, although they're called the Federal Reserve Bank, they're not federal. It says so on their website. They're not a reserve. They're not sitting on cash reserves, and they're not a bank because you and I can't go there to deposit money. However, they have the ability to essentially create money out of thin air. So when the government wants to spend $1.9 trillion that they don't have, a big chunk of this comes from none other than the Federal Reserve Bank. And because the Federal Reserve Bank doesn't have money, they have to then print these trillions of dollars out of thin air. And then they lend this money to the United States government, and then the government can take this money and they can use this money to build bridges. They can use this money to hire construction companies. They can use this money to pay off military companies, to pay off whoever they want to pay. But that's how they can stimulate the economy. So when the government goes out and spends money, it is a way to stimulate the economy because, number one, the government is giving businesses and people jobs. But the second part to this is when the government then borrows more dollars end up being created because the cost of borrowing the dollars, the interest rate on those dollars go down, which means the government can then borrow more dollars. And so if the government is then borrowing more dollars, that means more money can be created. And if more money gets created, what does that mean? Well, that ultimately goes back to what is the definition of inflation. If the definition of inflation is inflating the monetary supply, increasing how many dollars are out there, lower interest rates mean the government can borrow more dollars from the Federal Reserve Bank, which means the Federal Reserve Bank can then create more dollars, which means you have more inflation in that way. Because when you increase the amount of dollars without increasing the amount of wealth that you have, the value of each individual dollar goes down, which then in turn causes the prices of things to go up. See, we can take a look at how inflation affects housing prices, or how interest rates affect housing prices, how interest rates affect car prices. And we know that, yeah, lower interest rates can create more bidding wars and things like that. But ultimately, if you want to go to the root, you have to understand how this impacts the Federal Reserve Bank and how it impacts the government, because the government is the entity that's spending money they don't have, and when they spend money they don't have, they borrow this money from none other than the Federal Reserve Bank. Now, I have a video coming out on Monday where I'm going to be going over how lower interest rates are going to be impacting the housing market. So if that's something that you're interested in, make sure you stay tuned for that. But this is something that you want to pay attention to. Now, if we put all this together, if we understand that interest rates can impact the economy by stimulating spending, we understand that interest rates can impact how much money the United States government spends, does that create any issues of potential debt, of how much debt that we have? And this is a question that, unfortunately, some people don't want to answer, because many people believe that the amount of United States national debt that we have is not an issue because it's an amount of debt that we'll never pay back. It's just a imaginary number that's just sitting there on the screen and it doesn't matter. But it will become an issue if we borrow more money and we can no longer service our debt, if we can no longer pay back our interest payments, because then we'll have to borrow money to pay back our interest, which means we're using our Visa to pay back our Amex, and that's when that will become a problem. But I have another video coming out on this, a whole deep dive on this coming soon as well, so I don't want to go deep into that. But this is where your job now as a financially sophisticated investor is to stay calm and understand how things affect the economy and stop making emotional decisions in the market. Because unfortunately, what you see happen is when you see decisions with interest rates, people start to make trade decisions. They start to trade stocks, they start to trade things because they think that a certain thing is going to happen in the markets tomorrow. But that's not how wealth is built. We know that over the last century, we have seen recessions, We have seen market crashes, we have seen market booms, and we have seen sideways markets as well. Yet, despite that, the markets have gone up by an average of 10% a year. However, many people end up losing money. Why? Because they get emotional and they use the stock market as a place to gamble instead of as a place to actually build wealth. I'm not here talking about trading because that's a form of gambling. I'm here to talk about investing. And if you want to be an investor, what you want to understand is, number one, what is your strategy? How are you going to be investing? And then stick to your strategy, period. There's going to be a lot of day-to-day things happening, especially over the next few months. We have wars happening overseas. We have an election happening in the United States, and then on top of that, we have interest rates being cut. And so there's going to be a lot of emotions, but your job is to stay calm. And as you stay calm, remember that your job is to be a long-term investor, and what's happening in the day-to-day does not matter because you're investing for the next 10, 20, 30, or 40 years. So let the markets go up, let the markets go down, just keep buying. That's the way that you win. If you just keep buying, you keep holding, you're holding on to strong assets, that's the way that you win. But you got to remember, you want to stay calm when things go crazy, because we know that things are going to go crazy, especially when you have a lot of different things happening in the world, from geopolitics to our own economy to the political side of things. That's where you want to stay calm. And with that, I'll see you on YouTube tomorrow.